In this lesson, we will learn about basic acquisition financing. In 1989, Kohlberg Kravis Roberts & Co., KKR, acquired IJR Nabisco for $31.4 billion, marking it as one of the largest leveraged buyouts. KKR invested approximately $1.5 billion of equity from its fund. The remainder of the acquisition cost was financed through debt sourced from a consortium of banks, illustrating a high leverage ratio where a significant majority of the funding was borrowed rather than sourced from equity. This strategic use of debt magnified the potential returns on KKR's initial equity investment. Definition: acquisition financing is a specialized form of financing tailored to the unique needs of mergers and acquisitions transactions. It goes beyond standard corporate finance practices, focusing on securing the necessary capital to purchase another company or a significant portion of its assets. Unlike routine corporate finance activities, acquisition financing is characterized by its scale. M&A deals often involve substantial amounts of capital, requiring complex financing structures and careful risk assessment. Strategic focus: acquisition financing is driven by strategic objectives, such as expanding market share, acquiring new technologies, or eliminating competitors. Risk management: M&A deals carry inherent risks, and acquisition financing must balance the need for funding with the ability to manage financial risks and maintain overall corporate stability. Key objectives: the objectives of acquisition financing are multifaceted. Capital needs: the primary goal remains to fund the acquisition itself, often involving large capital outlays beyond the internal capabilities of the acquiring firm. Cash preservation: even when internal funds are sufficient, leveraging external finance helps preserve cash reserves for operational needs and further investment opportunities. Maximizing IRR: utilizing cheaper external capital relative to equity. Leverage effect is a tactic frequently employed by private equity firms. This strategy enhances IRR by reducing the equity portion and increasing the potential return through debt financing. This approach not only amplifies returns, but also allows for diversifying investments across multiple acquisitions. Cost of capital increase: the cost of capital is the return that lenders or investors require to compensate them for the risk of their investment. It generally increases as the risk associated with the investment type increases. Order and rationale: senior debt. It offers the lowest cost of capital due to its higher repayment priority and lower risk. Junior, mezzanine, debt. They carry a higher cost of capital compared to senior debt, reflecting their subordinate position in the repayment hierarchy. Equity. Equity demands the highest cost of capital, given the higher risk from its residual claim on assets and earnings.